Rob Barnett, EMEA lead of energy and commodity research at Bloomberg Intelligence. Rob, because I want to capture the collective aggregate of all of your amazing colleagues, because I know you guys were meeting in New York this week, and I've had a chance to put together your collective sense of where the world is at, and particularly the oil markets at the moment. So, Rob, your thoughts this side of a U.S. GDP number of 4.9% in the third quarter, and a rate or a inflation rate dropping recently, the latest print at 3.2%. How do those two things go together and end up with a minus oil price? Your thoughts?
Well, great to join you. And, we are always looking at the signals in the market. And we actually put out a note just yesterday that basically found sub $80 is the fair value of oil at the moment. And it's an interesting bit of work that a couple of my colleagues have done where they've built basically a regression model that looks at all the financial variables, including some of the ones you just mentioned, and sort of arrives at a price. And it's got a high adjusted R squared, a good fit. And despite all the geopolitical risk and everything else that's out there in the market, we can't seem to excite the oil market. And frankly, what are the factors there? Well, with inflation looking under control, I think that's going to essentially play into interest rate policy. And as you're probably aware, or at least some of the signals we're seeing, is that the demand outlook, at least here in the near term, is looking pretty bleak, and all those things add up to an oil price that really is not where some of the folks who are looking at the geopolitical side of the equation might think.
Rob, if I was going to Vienna as one of the members of the OPEC delegations next week, I'd be quite confused of how to read the outlook for the U.S. economy. You've recently returned there, Rob, and you've seen all the headlines, obviously, in terms of what one might expect. I was in America recently, and I didn't see any soft landing, hard landing, no landing at all. Is the U.S. economy going to get to its new dawn of back to basis inflation rate without a landing, and economy printing 4.9% in the third quarter? What's your outlook on that macro picture?
Well, it's a bit out of my realm to sort of prognosticate on the macro side of the equation. Although I would say, just being in the U.S. was traveling up and down the East Coast. Everything's humming along right now. So I think recessions are difficult to predict, and people have been talking about the possibility of one for some time now. And I think this is just not the kind of thing that you generally include in your base case. So let's see how things unfold. But the restaurants are busy. People are out shopping. There's very little indication to me that we have or that we're entering any kind of difficulty.
On that point, I mean, I know you've been talking with your colleagues about the outlook for rate hikes. Are we done? Is this now the point in which we plateau and the next move is a cut? Or given we saw the consumer price index come in recently beyond better than expected, which is this ultimately the backbone of the U.S. economy here. It's inflation at 3.2. Is that acceptable, or is the Fed going to have to look to do more? What's a growing consensus there?
Yeah, my perspective is that the market seems to have read the latest inflation print as an indication that the Fed is going to at least pause and possibly cut at some point. And you particularly can see it in some of the clean energy stock names. They all rallied quite a bit, and they've been essentially trading inversely with interest rates over time, over the last year plus. And the basic narrative there is that, higher interest rates affect capital intensive businesses. And so, if you're doing solar or wind, higher interest rates have basically been pumping the brakes on demand. And I do get the sense that, at least just looking at the stock price movements, that many folks on the street kind of interpret it as at least a pause.
The macro might not be your expertise, but I know all things IRA and the big bionic fund that the Europeans put together for the green infrastructure, if you like, and incentives there. Do they end up having to be something OPEC thinks about, because they're sort of the rubber's meeting the road in 2024 on some of these big investments? Your thoughts on those two mega funds that have come into play in Europe and America over the last year, but the rubber to meet the road on actual projects impacting new energy supply in 24, and that has to be considered when looking at supply of the whole. Your thoughts on that?
Yeah, of course. I mean, so look, I think at the end of the day, Europe and the US are racing pretty hard on clean energy, new energy technologies. And you've got these big infrastructure packages that are kind of helping to push demand. But at least in Europe, the gas price is still a pretty big driver. If someone who doesn't look at European gas prices very often, we're at about $15 per MMBTU in Europe versus about $3 in the US. That's a pretty big incentive to move forward on things like solar and wind. That being said, there have been some pretty high profile misses on those items here lately. The UK held an auction in September and got no interest in offshore wind. And the US has had some very high profile cancellations just recently from Ørsted on some projects off the coast of New Jersey. There is this sense that things are moving forward, but it's in starts and fits. And the higher interest rate environment, and we've seen a lot of cost escalation that's still working its way through, that have affected some of those project economics. So there's a lot of things happening on, say, wind, solar, electric vehicles, all of these things. But these are marathon type questions as opposed to sprints. So does any of that feed into OPEC's thinking about early 2024? I doubt it. But should they be thinking about how those things play into the general energy market narrative as you look out kind of 5-10 years? I think it's relevant.
But what about in the more immediate term, Rob, on that? One of the narratives that have been growing this year, and certainly we've been looking at it a lot, is, has energy security slayed energy transition? Is there or not in that sense? And where does the investment go into new oil capacity from the majors, or lack thereof? So I'm just curious as to where is that just a good soundbite, or has energy transition? You talk about Ørsted and the lack of auction buyers in the North Sea and so forth, and the wind side. Is it having an impact? Is it rushed energy security since Ukraine, and now with the issues in the Middle East?
I think most of that's more rhetorical than actual. So if you look at most companies, they're not really adjusting strategy too much. I mean, you've seen some headlines coming out from some of the European oil majors about some slight adjustments here and there, but they're still working towards long-term goals related to reducing their carbon footprint, and clean energy and all these other things play into it. So while I do think there is a little bit of a shift and a little bit of a narrative focus on energy security, I think the practical nature of most companies that operate in this space is that they're optimizing for 10, 20, 30-year projects, right? So the gyrations of the market, even interest rates, all these things don't really move the strategy component too much.